Angola, Ghana, the ones that are tuning in through our virtual channels. I would like to welcome you all here. Karibu sana. For me, is coming back home. I'm actually from here. So as a way of introduction, my name is Steve Munyao, for those who have not met me before. I'm a partner at Africa Insights. I'm also the GM and editor of Pensions Africa, based in Sandton, Johannesburg. And most of you, I think you're familiar with me, those who have been to the pensions events across Africa. To start, we just do the usual homekeeping. As you are aware, this event actually was supposed to be in Mauritius, and we had to change it to Kenya because of COVID regulations. Most of our Mauritius participants are supposed to go for a 14-day quarantine after going back home. And also going to Mauritius, we were supposed to get a 14-day quarantine, so we opted to change the venue. So that has inconvenienced a lot of our participants. Others have opted to go virtually. But with everything, we've managed to set up this, in a month's time and change it to Kenya. So we are good to go, and we hope everybody will have a good time. We'll have good interaction, good debate, good insights on what is happening in the pensions industry in Africa. So as part of our homekeeping, we will tell you this should be a COVID-free environment. We want you to keep your mask on. We want you to sanitize. We want you to social distance at all facilities. At every interaction that you will be having, we want you to make sure you observe all the regulations for COVID, whether it's shaking hands is completely prohibited. You keep your mask on, you keep your social distance, whether it's at residence, whether it's at where we are serving meals, everything should be observed according to the COVID regulations. The other item is you need to register. I'm told a few of you didn't register at the back. Your organizations usually request these registrations, your HR department. So make sure you're registered fully and everything of yours is captured. If you want any assistance, we've got Saya, who is with our guest relations. She's at the back there. You can let her know what you need. If you need to be assisted with anything else, whether it's travel, accommodation, she can be able to help you with that. I want to introduce the first speaker, who is Wayne van Rensburg. As I've said, he's the former president, just immediate former president of the Institute of Retirement Funds Africa. And he will take us through some of the key regulatory reforms that are happening in Africa, and what, according to him, what should be the focus in terms of reforms, in terms of pension system, regulatory reforms, investment kind of reforms and policies, governance and best practices. As I've said, Wayne is an attorney and he's been in the pension industry for more than 20 years. I don't know whether our team, we have Wayne online. Okay, so let's welcome Wayne and kick off. Thank you very much.
Thank you. Good morning, everyone. Apologies for not being able to be there with you this morning. Thank you for the opportunity to present and share some of my thoughts. I myself have had some technology issues this morning, so we're going to go through a slightly different version of the presentation, but we're going to cover all of it. I would like to thank my colleagues who are also going to participate later on during the course of the day. and talk about this very important issue. I mean, I think the reality is for most of us, pensions are our focus, and that's why we're here. Pensions is one part of a bigger social protection program that we all are part of, hopefully in some forms. I am going to focus and just highlight the things I want to discuss this morning, and then we'll work from there. Hopefully it will help you in your design, whichever stakeholder group you fall in. I've relied on 3 studies essentially, for the main part of the sub-Saharan African information, and I'll share those studies with you. And then the others are obviously, the other thoughts are my own, and those that I've gained through experience. I'm going to share the proposed outline with what I was going to talk about this morning. So it's just my organization. We don't have to worry about that one. Here's where I just wanted to have a look. I have limited my coverage to sub-Saharan Africa rather than focusing on the continent as a whole. I think we're all more familiar with sub-Saharan Africa, and the issues that we need to deal with there. What I wanted to do, and like I said, unfortunately, I've had a bit of a technology glitch, but I'll take you through the graphs and information as we go, just in a separate document. There is the pension systems design in sub-Saharan Africa. What do the pension systems look like, and why does that matter? Then the next issue I'd like to have a look at is coverage. Who's covered? And again, why does this matter? Then I think all of us are aware of COVID-19 and the impact COVID-19 has had on us. There's a particularly good study, and again, we'll have a look at it. It probably depends on one's political views, but it seemed like an informed study by the International Finance Corporation, obviously also related to the World Bank, looking at the impact of COVID and the impact on investment management in particular, but I think that relates to investments in general for retirement funds, and then proposed reforms. I won't necessarily be dealing with each one of these as a discrete topic. We'll be working through these 4 themes. The COVID theme we'll deal with separately, but the pension designs theme, the coverage theme, and the proposed reforms themes we'll deal with as we go. And then the pandemic, the COVID pandemic, and any other pandemic, well, crisis, I think that we need to start planning for future will be covered as we go. So I'm going to skip to another document. Apologies, like I said, my presentation seemed to have got a bit warbled, unfortunately, but I will take you through the information. For everyone, and I'm happy this is a public document, so we can have a look at that and share that going forward. The one document we're going to have a look at is this document, and it's actually one of the other documents that I wanted to share, not right now, so I'm just going to stop sharing. I apologize for that one. We're going to get to the right one now. And this is the document that I want to have a look at in particular. I think it's slightly, it's not that old, but I think it covers most of the issues that we want to have a look at. And when we have a look at the design, and I think what we can talk about in general, and when I was talking about the pension systems design, is that just to create the context, and then we'll look at the specifics. In sub-Saharan Africa, you'll see this report has had a look at quite a few of the sub-Saharan African countries, and what we find is that there are pension systems, just as by way of introduction. We have pension systems in place. The big issues are around coverage, and then we'll have a specific discussion around civil service pension funds and how those impact on the overall design of pension systems, and we'll understand that now. And then we'll also have a look at the difference between the mandatory and non-mandatory pension systems. And again, that speaks to coverage. So I want to take you just through this quickly and have a look, just to give you an idea of what the survey is doing. It's had a look at 44 sub-Saharan countries. Of those 44, they were able to have a look at 38 of the countries where there was enough information. And I think important things to highlight here is the actual type of systems that are in place across the continent. Of the 38 countries where like the information's available, you'll see 31 of them have a DB system financed on a pay-as-you-go basis. 4 have a provident fund benefit. I'm sounding silly. Let's retrace there a little bit. So of the 38 countries, DB pension funds, then 4 that provide provident funds, and we will have more graphs and stuff later on. And I apologize, I'll send a proper write-up a bit later. 2 countries, Malawi and Nigeria, have a defined contribution pension scheme, and then Ghana, the exception there with a hybrid. And then 6 of the countries, including my home country, South Africa, do not have a mandatory contribution system. And then we again going to have a look again at the civil servant issue compared to the country as a whole. I think what's of interest again, and I think it's a reality that we in Africa face probably more than many of the other parts of the world, is formal employment. And pension coverage is often linked to formal employment, as we all know, that either in the form of a mandatory system where the contributions will then come from nearly a tax, if you want to call that, to the system for all employed workers, or where there is either a supplementary or the only system that is linked to employment. So when we have a look at coverage, and this was something I thought really worth looking at, and there's a graph later on, is just the level of coverage as the system stands at the moment. And what I wanted to have a look at, I'm just going to scroll, and again, I will share all of this with you, is when we have a look at the countries and the type of design there is, we have a look at Angola, a DB pay-as-you-go scheme. And for me, the big issue here, if we have a look at it, is who is covered. So obviously, don't have information on most of the countries, but when we have a look at Cape Verde Islands, for example, 23% of the active workforce, that's the active workforce, is covered. As we go down, some of the places, and maybe it's just due to a function of size more than anything else. If we have a look at, say, Seychelles, for example, coverage relatively good. Mauritius, coverage relatively good. Again, issue of size. And we will get this just background, and we're going to get into the nitty-gritty of things now as well. So what we are seeing as far as this is concerned is that most of these systems are based on a pay-as-you-go basis. So that means it's related to actively employed people and people who can contribute. And this is a model that's been used across the globe well, it's been used across the globe. And it works in places where the active employed population is relatively big compared to the retired population that needs to pay for it. Africa at the moment, and employed Africa, obviously this still makes sense. However, as our population grows older, birth rates decline. It also implies that, you know, the number of workers that will be able to fund this going forward will decline, and the number of people receiving benefits will increase. I mean, it's an obvious thing I'm stating here, but you know that's part of the design that one needs to bear in mind. So again, broad policy issues here. We're trying to get some form of mandatory coverage. What I think the systems are achieving is providing coverage for those who are in some form of formal employment. And I know there are one or two pockets of places where other types of interventions have been put in place, but these are the big systems that are in place at the moment. So one is a funding issue. Second one is a coverage issue. And we'll look at this as we go on. So it's interesting to see that when we move away from the mandatory public systems and we start looking at either supplementary civil servant pension systems, is that the civil servant pension system is nearly a different creature from the average pension system in place across sub-Saharan Africa. And the reality is that the civil servant pension systems, as far as characteristics are concerned, are much more aligned to mature pension systems in developed economies. So it reflects that kind of reality. Older membership, relatively well off, longevity, probably based on the type of work and an education. So we're saying we've got a issue with, not an issue, but we've got a system that's dealing with everyone. Then we've got a special system for civil servants. And how effective is this as an allocation of national resources? And why I'm saying that, and I mean, I talk from South Africa, and I'm just highlighting this particular one, the South African employees, government employees pension fund. It's one of the biggest pension funds in the world. Expensive, lots of assets, all those things, but as a resource allocation, is that appropriate? And what I wanted to have a look at here, and I just want to go to this graph, and have a look at the issue. So one of the interventions that's been proposed as far as the pension systems are concerned is that if there is a civil servants pension system, nearly, if we call it a separate one from the national pension system, there is a definite thought that integrating the two would help, and that's one of the strong recommendations that come out, and we can explore that a little more. But when we have a look at the systems at the moment in the countries that have been surveyed, the 44 that are listed here, you'll see that in most of these, the civil servant pension system is separate from the national system. And the contribution rates are relatively high. You'll see in this last column, they're talking about the national system. Is there one in place? So Botswana doesn't have one, for example, but many of the other places that do, well, you're in Kenya, so let's look at Kenya, for example. they have a separate system for civil servants as opposed to the national system. And is this efficient? And is this something, not is this something? The thought is here is that conversations need to be had about whether this is something that is efficient and works for everybody. When we have a look, and luckily someone else crunched all the numbers for us, is the GDP that's spent on national pension systems, and why is that important? When we have a look at some of the countries, and I'm more focused on average, because I mean, we've looked at 44 countries, it's a lot of them. About 0.5% of GDP is being spent on national pension systems. And again, the question here is, how is this funded? Is it efficient? And although it's 0.5% of GDP being spent, who's it being spent on? And who's this actually reaching? When we go through the studies and we have a look at that high spend, but often the high spend is going to a very small cohort of people in the system as a whole. I just want to find this graph here for us quickly. When we have a look at civil servant pension expenditure compared to, you know, as a percentage of GDP, not surprising. I mean, we see this, but I mean, in countries like Zimbabwe, Swaziland, even Mauritius, if we see that the average spend on the national systems was you know 0.5%, on civil servant pension schemes, the spend is a great deal higher. And I mean, we can probably talk about the reality and the reasons for that, but again, national resources being allocated, and is that the appropriate allocation there? What we've spoken about up until now, sorry, is nearly, I want to call them occupation-related type pension funds. So the mandatory system says in most countries, you have to belong if you're employed, so it nearly becomes a tax. Then we've looked at the fact that they're the civil servant pension system, which in most countries is a separate system. And in most countries, the civil servant pension scheme has a slightly different characteristic from the national scheme. So what we're finding is national schemes are relatively young, might have surpluses at the moment, and we probably still have a, whatever they call it, you know, the youth benefit in most places, and allows us for opportunities to look at the design around that. Civil servant pension schemes, on the other hand, are different. They're older, they're more reflective of mature, or not mature, like more developed economies. So we've got that dichotomy, and having a look at the two separated systems, and do they make sense? The first question we have to ask is, before we move on to the next topic, is do mandatory pension systems work? From what we can see is that most policymakers in the 44 sub-Saharan African countries think they do. There are 6 exceptions to this, so that means that 38 of the 44 believe that mandatory systems are something that works. Then if that is the case, how effective is that? And I know I keep on harping on the same point, but who is it covering? If it is only covering the formally employed, and if we have a look at the research that has been done earlier, it would appear that in most of sub-Saharan Africa, and I know that's a very broad place to talk about, it roughly covers 10% of the population. So that means, again, coverage is relatively low because of the link to formal employment. And we're going to talk about some of the other interventions a little later. What this shows us is that we probably need to find pension or retirement saving solutions that are accessible to workers or people who fall outside the formal employment sector. And I think this is an obviously stated thing, but again, sometimes, you know, it helps stating the obvious. So how are we going to cover the rural poor, for example, hawkers, people with seasonal workers, informal workers? And I know, again, there are many places in Africa that have tried to create some interventions, and we'll have a look at that. But when we look at the big systems as they are in place, coverage low, this split between civil servant schemes and the national schemes, why would that conversation be important? Often civil servant schemes get probably more resource allocations than the national scheme, and the level of contributions being made. So number one, and I mean, in South Africa, we definitely need to talk about a mandatory system, but I mean, number one is, why the separate systems, and do we need them, and how can we move on? So I mean, that would be probably the biggest thing that I would talk about the system as it is at the moment. Then I don't know if there are any questions before we move on, because what I want to talk about now is more of a universal system, and those countries that have a universal system in place. Are there any questions before we move on to the next section? It's related, but I think this is sort of like a break before we move to the next area. Steve, or whoever's helping on that side, any questions? None. I'm going to move on then. Okay. So with coverage as a problem, how do we try and deal with a coverage issue? And what this is how this is dealt with is essentially non-contributory older persons grants. Well, that's what we call it in South Africa, and there are various names across the continent. But it essentially means that everybody who's reached a certain age can become entitled to a pension. And this type of pension is then either for everyone with nothing, age is the only requirement. And some of the other types of ways of dealing with this would be a means test. And that's what we do in South Africa. So if you don't have resources, what criteria do we put in place to say that you would be eligible? Maybe you have enough resources, so you don't have to get it, but if you don't have them, you do. And when we have a look at the schemes that do have it, South Africa, I think, has the oldest one. I think started in 1927, but I mean, with our history, we know that it wouldn't have covered the whole population. It does now cover more people, obviously, than it did in the past. And then you'll see that there are some of the other jurisdictions where they're starting to look, or other countries where they're starting to look at it, Nigeria, Kenya, and Uganda, for example. I haven't had an opportunity to follow up on those to see how far they are. But when we have a look at the the kind of expenditure here again on the old age grants, that's what I call them, or whatever we want to call it, universal pensions. Let's use that language. I'm so stuck in my home country language. Apologies for that. Is countries like Mauritius are spending a relatively high percentage of GDP on these universal grants. And why are we talking universal grants in general? You know, we're still talking at a system. We haven't got down to the specifics of the pension funds themselves. Is that, you know, how affordable are these types of benefits going forward? Research has shown is that they are generally quite good at alleviating old age poverty. It's just, how affordable are they in the long run, and how do we integrate this again with what we were talking about earlier on? a mandatory system for all employed people to try and save and build up assets for old age or older age, then if someone is too poor to contribute, how do we support them? Or how does the state support them? Because the reality, I mean, as much as we were talking earlier on about non-contributory informal workers, it often also relates to the fact that informal workers in many instances are very sophisticated as far as money is concerned, because they, you know, when you're poor, you have to make your money work really hard for you. But it also might mean that you don't have any resources to be able to save for the future. This is one of the interventions. And again, if we were talking in a perfect world, how do we make all of these things work together? So we've looked at these three, and I'm going to bring them all back together shortly. It is worth just seeing how many people are covered by this. Older people are covered by this. Some of these statistics I don't quite understand, and I think I need to write to them. More than 100% is interesting, but South Africa, 74% of older people, you know, Botswana, and some of these are relatively low, and we can have a look at the value if that's of interest to anybody. But what we can see is that South Africa is a means tested, and so does Cape Verde. But everyone else is just the other countries offering this. Just give it to older people. Again, affordability and sustainability going forward. And for countries with older people, how well is this working? When we have a look at national pension systems, sorry, I hope the flow is making sense. Because we spoke about pension systems in general, we spoke about a mandatory system for employed people. We mentioned the civil servant system, which also talks about some form of funding and someone paying for it with a dedicated resource allocation to that. We then moved on to the universal pension system, where it's basically funded by the state from taxes, no other form of special funding. So these are the attempts to try and cover people. Of the 44 countries, we see the 38 of them have a mandatory system. The coverage levels are not that great, or the information isn't that great. Civil servant systems are rich compared to national systems where they aren't integrated. The universal system covers most older people. Again, like the other systems, affordability is an issue. Then when we have a look at the coverage of older people in the system, national and civil servants pension systems, we see we still have relatively low coverage of older people. And I think that's a function of the economies that we live in, where many people are not in formal employment, and then haven't had access to some form of savings. But when we have a look at national systems, obviously there's some that are more successful than others. On average, the coverage is really low, you know, for older people. And for civil servants, the system does relatively well, as we can see. You know, I mean, just looking at Kenya, for example, Zambia, Swaziland, it's as if this sort of cluster of Southern Africa and East African countries nearly have the same characteristics as far as the civil servant pension coverage is concerned. Again, I don't want to get into too. I'm going to move on rapidly, because there are quite a few other things that we still need to talk about. All these, I will share all of this with you. It's in the public domain. What it is that we we're seeing, and I mean, when it comes to pension design and pension system reforms, would be the funding that's needed. As we saw earlier on, that many of these systems are based on a pay-as-you-go funding model. And again, that assumes that people will be employed and there will be enough people to finance the beneficiaries at the end. History has taught us that that's not necessarily a sustainable model. When we have a look at some of the countries that have long established systems with older populations, you'll see pension retirement ages keep on being pushed up, probably due to longevity as well. But it also means that people need to work for longer. So I'm not proposing a solution, but I would assume that where possible, the funding systems needs to look at a, excuse me, combination between pay-as-you-go, asset build-up, you know, various ways of ensuring that you can fund this, and also build in the reality that as populations grow older, fewer workers are available, that's an important element in the design of the funding. Again, we can just have a look at the contribution rates there. And not surprisingly, and I mean, I haven't touched on the reality of that.
Thank you.
Sorry. Yeah.
Okay.
The reality is that for civil servants, the pension contributions are so much higher than the average. And
which Thursday? Tomorrow.
All right, sorry, I just think I've got some feedback there, but everyone can hear me, I hope, and everything's all right there. Then
thank you.
The other element that has come in over and above the national system is the type of benefit that you're giving people at the end when it's a defined benefit system. Because remember, we mentioned that most of the systems we've had a look at is a defined benefit system. So it's going to say, we're promising you something at the end of your career. And what is it that we're promising you? We can have a look at the accrual rates. According to this World Bank study, these accrual rates are high by international standards. As you can see, the promises being made there in some of these places after 30 years of places, some of these countries, after 30 years of employment, are high. And remember, someone's going to have to fund that. And where is that coming from? And this is what I thought was interesting. Not that we necessarily always have to compare Africa to the rest of the world and the OECD in particular, but if we have a look at the accrual rates in some of these local or sub-Saharan African countries compared to OECD countries, we see that the accrual rates are significantly higher on average in sub-Saharan Africa. So another element where there is a DB scheme to have a look at and to consider, the related issue here when it comes to final benefits would obviously be which salary have you used to calculate the final benefit. Again, there's a survey and then it shows you the types. You'll get this information. If you're a regulator or a national pension scheme, that's obviously going to be of some interest to you there. And then the factor that also has a relatively big impact is the age at which you can claim retirement benefits. Some countries allow early retirement from age 45. Lucky people who are able to retire from there. But think about it, it obviously has an impact. The earlier someone retires, the longer you have to pay pensions, you know, all these things. Again, a design element as far as national systems are concerned. And then the life expectancy of people after retirement, again, important when it comes to funding and planning. And the normal retirement ages. And if we have a look at the retirement ages in sub-Saharan Africa compared to OECD, again, this is not, it's just a comparison. I'm not saying, this is the answer, but what it is showing us is that it is younger, and it means there are fewer people. Well, there's less time either for people to contribute to other people's pensions or to save towards other pensions. I'm not going to get into how pensions are increased. One element that I just wanted to mention in passing is when you do look at social protection, and in sub-Saharan Africa, the older persons grant we've spoken about is very important. But another intervention when it does come to budget allocation would be support for children and younger people, where obviously in sub-Saharan Africa there's a greater percentage of younger people and young people that are in need. Again, worth reading and having a look at when you get there. And then national retirement ages, we have touched on that. I'm not too concerned about that. And we've spoken about all these things in passing, but I think these are really important things to consider on a national level, and then we'll get back, eligibility, benefit parameters, and contribution rates, things we've all touched on. So for me, this was the quick sweep across that. And I mean, many of the people sitting in the room, they're obviously not in working on the national systems. You're more working or associated with an organization that is a supplementary organization to the national system. I would assume that in benefit design and taxations, because I mean, I'm assuming we're talking a very broad number of organizations across a broad number of countries. The national system would be something that you would consider in your benefit design, and or the employer with you as a fund would consider as part of the overall way of providing a retirement outcome. What we know, and I'm sure it's similar in other places, is that in South Africa, the South African Constitution says that we need to work towards providing some form of social benefits to people. These benefits can either be through the state, and that would be something like the social old age grant. We don't have a mandatory pension system, but if we did, but one of the partners in all of this would be parastatal or private institutions. So it would be private pension schemes or employer-specific pension schemes would also be part of that overall system. So when we're talking to national or to policymakers, we need to say, in this mix, this universe of things, of solutions that we can find, mandatory system is one of them. Obviously, providing a pension outside the mandatory system would help people save more. And how are we going to incentivize them? In many countries, there is an incentive, a tax incentive for making additional contributions. So you reduce your tax liability. So it's sort of like, I like calling that, discounted saving, because of the tax break you get. But how do you motivate people outside the system? And again, yeah, we're still focused on mostly formal employment and the opportunity with informal employment. So those are the broad things that we've had a look at, and the system as a whole. Reforms, I think we're going to get to that more in the pension system. Reforming structures is obviously much more difficult than maybe tweaking some of the existing things. As a policymaker or as a government, I would assume that our goals would be to try and cover as many people as effectively as possible within our budget, you know, as fund representatives, asset managers, service providers within the system. How do we provide the best possible outcome, and where and what is it that we can do to supplement? So I've now done the sort of like social good bit of the conversation, the very broad, you know, we need to achieve good things. I think financial inclusion is a really important thing. And in the next section, where I'm going to focus on COVID for a bit, well, not for a bit, just talk about COVID and some of the things we can take away from that experience, is some of the interventions that have been created. Again, I'm going to summarize and move on and then ask for any questions before we move on. It seems policymakers think that a national scheme is appropriate. Yes or no? Civil servant scheme separate? Should they be? Yes or no? Is coverage adequate? Yes or no? Where coverage isn't adequate, what is it that can be developed? We're going to touch on micro pensions a little later on, because I know there are a few countries where they've been either implemented or the law is there for implementation, for a broader informal sector type of coverage. Any questions before we move on? No questions. Perfect. Then sorry, Steve, is there? Are there questions? Can I move on? Okay, I'm gonna move on. So the next report, and this is a relatively recent report, and I was happy I could find it because it was really insightful and gave a lot of information. What I do want to say is that this report excludes South Africa. South Africa is just a exception for some silly reason, just has not silly reason, just has a bigger pensions base, and I will share these reports with you. What this report is talking to, and we're now saying we understand the bigger system. We're now going to become a little more focused on individual schemes and asset managers and trustee decisions around assets and things that can be done, and kind of reforms that would need to be done. The first thing that's been identified, and I think that's the reality, is probably that most non-national schemes have moved from DB to DC, with the exception of a couple of big, probably national funds, civil servant funds, probably, but a big move from DB to DC. So the funding issue and the type of thinking around investments shifts. So this isn't quite COVID yet, but it's just a discussion around that. What this means in the bigger scheme of things, and I'm sure, I hope I'm not boring you when I'm stating the obvious, with a move from DB to DC, obviously the shift is away from the employer as a guarantor of whatever. And the fund not all of a sudden, well, yeah, kind of all of a sudden, is now responsible for ensuring that the funding levels are appropriate and that the retirement outcomes are appropriate. And how is that achieved? I mean, there are many ways, and I know we've seen, I'm sure you've probably all had these conversations with yourself or people who assist you with your thinking. Everyone tries to sort of I call it, nearly call it reverse engineer. Was that the word? Reverse engineer DB schemes, you know, where you're saying we're trying to work towards an outcome of X of final salary. So I'm just going to use a silly example. You know, as a fund, we are trying to help people who are members of this fund for a period of 30 years to achieve a retirement income that is equal to 50% of their last salary. I'm again just using an example. And how do you do that? So you're no longer guaranteeing that in the rules by saying, well, you've accrued your 50, so fund, it's now your problem to have the assets to pay this pension going forward. The reality is you now have to develop an investment strategy and contribution rate that will allow you to achieve that kind of outcome. And what is it that we see? And again, like I said, we've excluded South Africa. The biggest pension system outside South Africa, as far as assets are concerned, would be the Nigerian system, which is growing rapidly. And as we can see there from that information, you know, that system had, or the asset base has grown ninefold in a period of 14 odd years. And we're going to have a look at Nigeria in particular, and when we're going to look at assets and asset allocation and the type of investments that can be made. And maybe that's one of the big, not maybe, that is one of the big policy interventions that needs to be made, I believe, to provide appropriate investment opportunities. And then in some countries, in Namibia, they talk about it in particular, high concentration of large funds. And I don't want to bore you too much with the details, but just interesting to see that what we are seeing over and above the other things we've discussed is that there is a rapid increase in pension assets across the region. And excluding South Africa, we're looking at the top 5 regions, Nigeria, Kenya, Namibia, Botswana, and Mauritius. And we're looking at the pension asset value as at the end of 2019. And when we look at the assets under management as a percentage of GDP, we see it steadily growing. And in countries like Namibia, Botswana, and South Africa isn't included, you know, the pension assets are substantial relative to the GDP. Again, this becomes important when we look at some of the interventions and types of investment opportunities that may be available going forward. I'm not going to get into too much of the really boring, not boring stuff. This is all very interesting solutions. And I'm not going to stop on this one for any Kenyans there and anybody who was part of that. It was an interesting read. I think what I want to talk about, just in broad terms, and then we can look at some of the statistics, is that what we find is that the types of investments permitted in various countries across sub-Saharan Africa vary. And when we have a look at the asset types that are allowed, we find that in, and I'm just going to use Nigeria as an example, and then maybe Namibia or Botswana as another example, is that a lot of the pension assets are invested in some form of debt, like a government bond or a related type of instrument, which, as we know, don't necessarily define themselves as growth assets. I'm not saying they're not, but they're not necessarily the same types of opportunities as you would get investing in an enterprise or a project. What we also see with that is the potential of the risk faced by scheme members where governments are unwilling to pay. And I mean, I'm not saying that's necessarily the case. The one example, if we look through at this paper, is where there was a suggestion that some of the government interest payments or coupon payments on pension owned, on bonds owned by pension funds be reduced, be suspended, essentially saying that there is a situation where the debt is being restructured, which may or may not be a good thing in the long term, but it does mean that there's an impact on the asset value and benefits of members. So I think what I wanted to talk about here is when we have a look at this chart here and the type of assets that are being invested in, we'll see that there are, and this talks specifically to securities and capital markets. You'll see that there is a allocation, quite a high allocation, potentially that the regulator allows. However, the reality is that the level of equity investment is relatively low, even in local terms, and then again relatively low, except for Namibia and Botswana, when it comes to foreign securities. So again, regulatory interventions, when I'm sitting as a board member on a fund and I need to look at asset allocation and I need to speak to the regulator and say, I want to do good, obviously for my country, but I also need to do good for the members that we represent. How and what is it that we can do? When we have a look at international studies, and it's not included in this, and I'm happy to share that with you. If you have an interest, you can just drop me a line or ask Steve to drop me a line, is that many retirement funds across the globe have quite a large allocation to investments outside their home countries, for a whole lot of reasons. And in Africa, sub-Saharan Africa, we probably face the reality that the investment opportunities in liquid markets or equity markets are probably low because the markets aren't that big, especially if you have large assets. However, the offshore or foreign investments are a big part of most international retirement funds. And I think it just talks to the reality that there are some markets that are bigger, and it probably makes access for a local investor to have some to access some of those opportunities. I'm just thinking, as a silly example, it would have been great, and not that I'm encouraging that, but if you could have invested in Tesla, for example, a while ago when the share price was low and it's grown significantly, that problem of funding and providing those promises we make becomes not easier, but there are more opportunities to be able to access the global market. And I'm not encouraging a situation where I'm saying everything needs to be invested in, offshore. I'm saying there is definitely, and everyone would have a sweet spot where it makes sense, that a certain percentage of your retirement assets should probably be invested outside your home country for a whole lot of reasons. So I think that for me, over and above the other things we've spoken about, and it's particularly for employer or occupation-based funds, would be one of the regulatory opportunities that needs to be explored. And the fact that it's also not being taken up is very interesting, especially when we have a look at a country like Nigeria, where there is such a low uptake of securities. And I know the argument for some people is that the local markets or the capital markets aren't adequately developed. I don't want to get into a whole debate around local capital markets and access and all those things, but that is one of the arguments. And I mean, I think we're going to get there. But part of this policy drive, although the policymaker has now given it to the decision makers that you can do this, they're not doing it. Why are they not doing it? Are the opportunities not there? What other things need to happen to encourage this? So again, broader question there as far as that is concerned. But I'm saying it's there. Why is it not being utilized? And the other issue that's been highlighted, and I mean, this for me is another interesting thing to have a look at, is the amount of assets or total assets being invested in short-term liquid type of cash instruments. The reality here again is that we all know that cash is kind of safe in the short term, but it's not a growth asset. It's not helping us achieve that 20, 30-year investment horizon. And are policymakers encouraging funds or asset owners appropriately to achieve and diversify appropriately? Again, just observations. It's probably more evidence than anything else to mention it. And then what I want to move on to is where and what kind of assets, asset classes, domestic and foreign, are being looked at here, and why does that matter? Although, you know, the argument is that I live in country X, so my liabilities in country X, I should be encouraging the growth and development of country X. That is not necessarily the most appropriate way of achieving an investment, well, diversification that's appropriate for a fund. And I know I'm not supposed to be talking about asset management, but it does touch on that. And policymakers, as much as they're creating the big system, they're also saying, well, here's the way you can invest stuff. And if they're creating parameters and stuff, are the policies being communicated appropriately, and are they creating the right information flow for the decision makers to be able to make these decisions? And again, when we have a look at this, it's astounding to see, you know, that in Kenya and in Nigeria, 99% of the assets are in local investments. Just when there's a whole world and other opportunities to look at. And my time is up, I think. Steve, what I wanted to touch on and to finish off with, as far as these things are concerned, is that in Africa, sub-Saharan Africa now, or economic union that give us opportunities to again see how we can work together. And I haven't touched on some of the feel-good stories, just that we see that we've got pools of assets here. We've got pools of assets that need to generate income. We've got pools of assets, and in this paper in particular, they talk about pools of assets that can do good, help with post-COVID, you know, crises of whatever nature. What we're seeing here is, besides the asset allocation, we were talking about government bonds, we were talking about equities, And then there's also a big drive towards infrastructure investment and the way that's structured. I know later, and some of the delegates here are part of the Kenyan consortium that's started looking at that from a Kenyan level. But with these large pools of assets, we could probably start looking at regional and cross-continental opportunities for investments and finding investment opportunities. And where and how can we make that happen? And I think one of the big policy reforms there would be, when it comes to fund specific types of investments, is the policy makers and the policy allowing, the regulations allowing investments across borders, collaboration across jurisdictions, and what kind of mechanisms do need to be put in place to achieve this? So I hope this has made some sense, and I know he's talking about reform. I tried to start very wide and move down narrower to a much narrower point. I'm stopping before getting into a whole conversation about financial inclusion and some of the interventions that are available there. There is definitely an opportunity to talk about that. I know Rwanda has launched large-scale, micro pension and inclusive interventions. Nigeria has the law in place. Ghana has it in place, and some of the participants participate in the micro pension situation. I know Kenya has it in place. So those are the financial inclusion elements. Good, and I mean a whole topic on its own. For me, as far as policy is concerned, we've had a look at the broad strokes of the policy. On a national level, does it make sense? And is a defined benefit pay-as-you-go system the most efficient way? Do countries have resources to do it any differently? When we get down, and I'm now sort of skipping a whole couple of tiers to retirement funds, as a trustee of a fund, is the policymaker and the regulations where I'm sitting allowing me to make the appropriate decisions? What I'm seeing and what I'm observing is that possibly not, but there are opportunities and things that funds may not be considering, especially when we have a look at things like this, where, I mean, not the domestic assets are a big issue, but diversification as far as asset classes are concerned. Seems like the regulations there, seems like the policymakers encouraging it. However, the people making the asset allocation decisions or buying the investments are not feeling this or not agreeing with it. So are the policymakers making the right policy to enable you to do that? Let us think about that. I hope this was useful, and I will share all these documents with you. You can take away. I think for the broader elements, lots of information. For country specific and asset allocation, definite opportunity to move on and consider and see what it is that needs to be done. Please let me know if there are any questions, and then I'm going to move on and hand over to the next speaker. Thank you.
Okay, do you have questions? We have a few. Wayne, you stand by.
Sure.
Morning. Morning, Wayne. My name is Talita.
Good morning.
I was just looking at what you were sharing on, and I'm looking at a situation where in most sub-Saharan African countries where the retirement age has been increased. But my worry is that with the young people, very few of them are getting into formal employment.
Formal employment,
So
yes.
it's becoming old, but we have very little new growth So how are we going to sustain the pension industry? How are we going to spread it out, knowing that a large majority of the population in the African countries are not covered by any retirement or pension scheme? Thank you.
Thank you. Maybe you should take one or two more, Steve, and then we can try and.
Okay.
Yeah.
Kindly sanitize and introduce yourself.
Thank you. Good morning, Wayne. Matthews Chabala from Zambia Insurance Pension Trust Fund. My questions is on mandatory contributions. Well, in the light of COVID-19, which has amplified a lot of risks in the pensions fund and in our retirement income systems. You mentioned that to improve some of the long-term outcomes from the retirement income system is to increase the coverage of employees, including non-standard workers and self-employed. Now, the big concern is that our government debts is likely to limit the ability of future government to support the older population with pensions payment and other services. What are some of the interventions that you've deployed to mitigate these risks? Thank you.
Thank you.
Do you have another question? Okay. Wayne, can you go ahead?
Sure, thank you. I think both these questions talk to coverage and crisis and social protection in the broad sense. So I think mandatory systems are difficult because of that link to formal employment. I know there are speakers, and I know we'll touch on this later on, that have worked and have developed things in the micro pensions environment. Unfortunately, I didn't bring a case study along, but I know Rwanda in particular, I'm just using that as an example, has done an extensive work on financial inclusion and developed a kind of micro pension system where it's more ad hoc. It's maybe not as formal and covered as you are talking, but it does create the opportunity for the buildup of assets, for savings and for retirement benefits. So I think the biggest problem with mandatory systems and all sort of state-sponsored systems, not that I'm not a state, the state has a very important role to play, is that when something isn't funded and it has to come out of a government budget, and a crisis like COVID hits us, we know that there are issues. So again, it's a question of affordability, but different ways of looking at that. So I'm saying that there's not one answer. Sorry, so that's actually the answer. There's not one answer. Aging populations are a big issue, just to deal with the first question. I think you probably have to have multiple types of interventions where you encourage people to save themselves, where the state itself, if it's not a pension scheme in particular that it's creating, might create some form of sovereign wealth fund that can fund benefits in times of difficulty. So I'm assuming there are going to be times where the state has extra capacity or has some special type of tax on mining, tourism. I'm trying to think of the things that we have, in sub-Saharan Africa, where there might be special taxes, where a portion of that money can be allocated to those types of funds. So I'm thinking, I hope that answers your question. There are multiple ways in which to do this. I think allowing informal payments, ad hoc type of savings, and making these ad hoc savings really cheap and accessible is probably the biggest issue. So the short answer is we need savings vehicles that are cheap and effective to allow people to save more, and that might be on a national or even a private level, with some form of emergency funding, like I said, in the form of a sovereign wealth fund or other vehicles that people or governments use to provide protection. No easy answer, unfortunately. But I hope that provides some guidance. Like I said, the Rwanda Financial Inclusion Project is one that's probably something to look towards. Thank you.
Okay.
Thank you, Steve. Thank you, everyone, for
Do you
listening.
have any other question?
Thank you.